a great pleasure to be here. Thanks for picking our paper. This joint work with Amir, Sufi, and Viswanathan at Duke. I'm also flattered that I get to present in an asset pricing session, and I hope it doesn't come as too much of a disappointment that I will not be speaking about asset pricing. I will be speaking about dynamic corporate finance. At least the hope is that that's my comparative advantage. So here it goes. So this is about dynamic risk management. The question we're trying to ask in the paper is, we're trying to understand risk management. And in particular, if you think about the recent financial crisis, obviously the risk management, and in particular the absence of risk management or the limited extent of risk management has gotten a lot of attention. So we think we should try to understand that the model for risk management we're going to have in mind is a model where firms are contemplating risk management due to financial constraints. Okay, Viswanathan and Stein have actually proposed a model like this and shown that firms subject to financial constraints are as if risk averse and hence have a motive to hedge. Okay. What people have taken away from that literature is that more financially constrained firms should hedge more. Okay. Now, the problem with that was that when people looked in the cross-section, they saw that the small firms actually don't hedge, and to the extent that anyone hedges, it's the larger firms. Okay. So the size pattern somehow doesn't seem to square with this idea that the more constrained firms hedge a lot. In fact, Stultz, for example, argues that the actual corporate use of derivatives, however, does not seem to correspond closely to theory. Okay. So what we're going to do today is rethink risk management, and we're going to first do that both theoretically, and then as well, then also empirically. And the basic theoretical insight is going to be that there is essentially a basic financing risk management trade-off. The idea is simple. When you raise financing, you issue promises to pay next period. Similarly, when you engage in risk management, you issue promises to pay. Now, in a world where there's collateral constraints then link your ability to make promises to financiers and your ability to make promises to counterparties. Okay? So it's the collateral constraints that induce this link between financing and risk management. And then what happens is that when firms have low net worth, they essentially use all their net worth for investment or to scale down less at the expense of risk management. So what our dynamic theory will predict is that more financial constraints firms hedge less, not more. Okay? We've actually argued this in a couple of previous papers, and what we're doing here, which is new, is we're thinking explicitly about hedging a stochastic input price. It turns out that typically in practice, firms actually hedge a particular input price. For example, airlines hedge the price of fuel. On the empirical side, then, we revisit the evidence given these theoretical predictions. And what we do is we look at fuel price risk management by airlines. And what we're going to show is that more constrained firms hedge less, both in the cross-section and then importantly also within airlines over time. Okay? We'll in fact see that there's a remarkable pattern in terms of airline fuel price risk management where risk management drops substantially as airlines approach financial distress. What's new here is that we are able to exploit the within airline variation to shed light on the connection between financing and risk management. We'll also give a bunch of anecdotal evidence that is consistent sort of with the line of thinking in our models. In particular, for example, if you look at American Airlines, they say in their 10K that a deterioration of the company's financial positions could negatively affect the company's ability to hedge fuel in the future. That's exactly the kind of concern that the firms in our models will face. All right, I've said this a little bit, so essentially what people saw is that the smaller firms seem to be hedging less, and Viswanathan and Stein, for example, argue this seems to be generally inconsistent with our model if one believes that smaller firms are more likely to be liquidity constrained. And then when people, such as Tufano, take the theoretical prediction to the data, they actually look for, they also think that what they're expected to find is that an inverse relation between firm size and how much people hedge. And in particular, again, the argument there is that smaller minds might engage in greater risk management so as to avoid having to seek costly external finance. And again, our basic trade-off, of course, has the exact opposite prediction, and then we'll look at this in the data. Don't want to say much about the literature. Maybe one thing worth pointing out is that a large fraction of the literature actually uses single cross-section and categorical data. Essentially dummies, do you use derivatives or not? Instead, what we have is we have data at the intensive margin. How much do you hedge? What fraction of next year's expected fuel expense do you hedge? I won't say anything else about the literature in the interest of time. All right, model. The model will be, so this will be a model of commodity price risk management. It's going to be a firm. Think of it as the airline. And it's going to be in discrete time and have an infinite horizon. It's in principle risk neutral, but subject to limited liability. Discounts the future at this rate beta less than 1. And it just maximizes expected the discounted value of dividends. It has access to essentially a neoclassical production function with 2 inputs. Aircraft and fuel. Okay, aircraft K, depreciated rate delta. There's no adjustment costs of any kind, and then you need fuel, which you're going to buy tomorrow when you actually fly at the stochastic price P prime. The prime just denotes variables that are measurable as of the next period. So cash flows then that you generate is you have some productivity, you use your aircraft and fuel to generate cash flows. And there's going to be decreasing returns to scale. And then we'll have a Markov process on both that is going to drive both the fuel price and the productivity. The outside investors are essentially uninteresting. These guys are deep pocket guys. They're risk neutral. They're patient relative to the firms. And they're essentially willing to offer any contingent claim that the airline would want at an expected return R. To understand risk management, what we're going to allow firms to do is they have, in principle, access to complete markets. So to the extent that firms here will at times not hedge, it is not because they don't have the possibility to. Okay? So we'll allow risk management, and we're actually going to allow these firms to both issue stay contingent promises to financiers, as well as by forward purchases. In particular, you can buy the input, say fuel, a certain amount, say 1 million gallons, at the forward price of $5 per gallon, say in a state of the world where maybe the price per gallon is $3. Now, importantly, what's the friction? What makes this interesting? The friction is limited enforcement. Okay? Firms can, in principle, default on their promises. What happens when they default on their promises? What happens is, well, so they can default on the promises they make to the financiers, and they can default on the promises they make to derivatives counterparties. In particular, they cannot take delivery of the, like, say, million gallons that they were promising to buy at $5. Now, the good news for the counterparty is that if the firm defaults, then at least you don't have to ship them the 1 million gallons of fuel. Now, when the firm defaults, it can abscond with all cash flows and fraction 1 minus theta of capital. We show then that this means that all promises need to be collateralized. So both promises for repayment of financiers as well as for forward purchases. Okay? So what happens is promises need to be collateralized. How? What's collateral in the world, in this model? Collateral is just the capital that you have. In our model, it's airlines, so they have aircraft. They have aircraft here, K, but next period, when it comes time to enforce, they have depreciated. Up to fraction theta of that, you can pledge. Okay? But to whom? Well, you need to both pledge, you need to back with collateral both the promises you issue to financiers as well as the promises you issue for risk management purposes. Now, risk management we should briefly look at, it's the forward price minus the spot price. Y goes like this. If you promise to pay $5 in the state of the world where the spot price is $3 for 1 million gallons, then what you need to collateralize is the extra $2 million, right? 5 minus 3 times the amount that you purchased, okay? So both are now charged against the collateral constraint. You see now how the collateral constraints start to induce a connection between financing and risk management. All right, so then we'll do a little more work. First,
the collateral restriction go back depends on random variable that you don't know today. So
I'm sorry? So this is a state-by-state constraint.
That's a state-by-state.
Yes, absolutely. You have complete markets, so in each state, the promises against that state have to be they're all collateralized by the same aircraft.
So B is basically the max.
Well, because you have complete markets, you can choose anything any random variable that you want, any payoff that you want, so long as it is less than this. Yes.
Why don't they buy options?
Very good. I'll talk about this. So they can also buy options. So this actually comes up in practice. You could just, one way to avoid collateralizing things is just buy options. Well, and then it'll be even, and in a second I'll show you that actually the best way to write the problem is exactly this way, and then it will be very obvious that risk management requires net worth, right? But I'll actually show that without loss of generality I can write it this way. So I'm not ruling out any forward contracts or anything. Everything is there, but I can write it this way. Yes?
Sorry, I don't want to hold you up, but isn't the second term redundant? So if you
very good. So I'll simplify things a little bit. You're right that right now I have a little bit it's too complete a little bit. Yes, absolutely. All right, so, but it's important for a number of reasons. So first, notice that the airline next period, it can still buy or sell fuel at the spot price. So importantly, how much fuel it uses next period is not dependent on whether or not the airline has hedged. All that hedging does is you buy a certain quantity at a certain price. What hedging does is shift net worth across states. It does not affect the price at which you operate. And this is important. What it means for practical purposes, it means we can just optimize it out. So we can just optimize out, and so essentially the fuel now disappears from the entire thing. And you get actually this fictitious productivity, which essentially means what's a high fuel price? High fuel price, your cost is high. It's as if your fictitious productivity is low. And a low fuel price is your cost is low, and it's as if the fictitious productivity is high. Okay? And note, then you stare at this a little more, and you say, look, one thing that's important to observe is that fictitious productivity is actually convex in the spot price. And this has created some confusion in the literature, because convex in the spot price, it sort of means that you think like now the firm doesn't want to hedge. But note, the spot price is not what you hedge. Hedging shifts net worth around. It does not affect the spot price. But there's a number of papers in the literature that proceed as follows. They do an ad hoc approach to risk management. They just say the firm has the stochastic price if it's not hedged. And if it's hedged, it faces the expected value of that price. Well, that's trouble. There's a concern with that ad hoc approach, because profit functions, actually, this is basic microeconomics, profit functions are convex in prices. So some papers, including papers published in top journals, then just go on to assume that profit functions are in fact concave in prices, which violates basic microeconomics. Okay? So, but the point is, again, so what's the basic insight? Basic insight is, so profit functions are convex in prices, but hedging does not change the spot price. What hedging does is shift net worth across states, and the firm's problem is concave in net worth. Okay? So that's why this is important. So now we can then simplify further. We can actually say the simplest way to write the problem is like this. Whenever you buy an aircraft, just pledge everything you can against it. So essentially just pay the down payment and pay 1 per unit of capital minus what you can pledge. Right? So you pledge whenever you buy an aircraft, you pledge everything you can. There's nothing left to pledge. So now what? Well, if that's the case, then how can you hedge? Well, you can hedge now, but subject to short sale constraints. So an equivalent way of writing it, the problem is to say, whenever you buy an aircraft, you lever it fully, and then all you can do in terms of hedging is buy state contingent claims subject to short sale constraints. That's the way I write the problem. So the simplest way to write the risk management problem is to say, the firm is there with it, this is the value function of the firm with its net worth in a given state. It maximizes the expected value of dividends. And it looks like this. It wakes up, it has some net worth. In principle, it could use it to pay some dividends. And then apart from that, it can buy fully levered aircraft, invest, or spend net worth on risk management. Right? And now you see very clearly that there's an immediate connection between investment and risk management. If you want to use net worth for risk management, you can't also use it to invest. And then all that's going to happen is when you're very constrained, you want to use it all to invest or to scale down less. Okay? Then tomorrow, of course, you're going to have your cash flow, you're going to have your aircraft net of the debt, plus if you bought a contingent claim, it's going to pay off. That's going to give you your net worth tomorrow. And all the collateral constraints and so on and so forth reduced to just a short sale constraint. All right, so then the basic insight, we can...
Go back. So it's choice now between dividends and doing your own,
Oh, absolutely, yes. So only if you're sufficiently well capitalized will you start to pay dividends. Absolutely, that's also there. All right, so the basic insight then is that when you're studying this problem, essentially when you're very constrained, you spend all your net worth on investment or to scale down less instead of risk management. I have to ask Ken whether I get some, can the audience borrow from it the time it has at the end to ask questions? No. Okay, good. All right. Okay. So let me go on for a little bit then. All right. So the basic insight then is in a picture. So here's essentially, if you want to keep just one thing from the theory, it's this picture. It just says, look, suppose tomorrow you have a state with a lot of net worth and another state with low net worth, because it's as if the firm is risk averse. What it would want to do, risk management, would be shift net worth from the high net worth state to the low net worth state. But if the firm also might want to do risk management, then it wants to also shift net worth to today. In fact, if the firm also has an investment need today, it might want to shift net worth today from the high state tomorrow. And in fact, if it's very pressing to not sell off even more, be forced to sell off even more aircraft, then you want to shift as much as you can from the high state and the low state to today. Okay. So that's the basic prediction. Basic prediction, again, both in the cross-section, so the more constrained guys should hedge less. And within firm, as you're getting more constrained, you might reduce risk management and completely stop. So let's look. The way we look is, our empirical laboratory is airline fuel price risk management. Okay? Why airlines? For fuel is a major cost. It's also the fuel price is very variable, so that works out well for us. But more importantly, actually, we have data on airlines. And in particular, they give us essentially the intensive margin of hedging that tell us what fraction of next year's expected fuel expense have you hedged. That's what they say in their accounting statements. So we're going to exploit that. First, just to warm up, but airlines actually explicitly pledge aircraft at times to derivatives counterparties. Southwest, for example, has agreements with counterparties in which cash deposits and or pledged aircraft are required to be posted when the net fair value of derivatives falls below a threshold. Specifically, they have agreements where they can pledge 20 Boeing 737-700s in lieu of $400 million to one of their main counterparties. Okay, so they explain, and obviously if you pledge it to the counterparty, you can't also pledge it for financing purposes. So the data, the first thing I want to tell you is that essentially we have about 15 years worth of data, about 23 airlines. How much do people hedge? The airlines that are of interest to us hedge about 20% of 1 year's expected fuel expense on average. But there's considerable variation. If you look, the Southwest, which hedges in our data more than 60%, and there's some that hedges essentially nothing. So cross-sectional variation is good when you want to do empirical work, I am told. All right, so now, importantly, so what was the basic prediction of our model? So the basic prediction was that net worth, right, what's the state variable in our model? It's net worth, right? And it says that the more constrained guys might hedge less, and in fact, they might not hedge at all. So what we did is we then went to the data, and we defined essentially what we thought were the closest measures of net worth in the data in various ways, both in book values, in market values, scaling it by assets and not. But essentially what I want you to see is that here net worth versus how much do people hedge, there's a strong and positive relation between how much people hedge and their net worth. The more net worth, hedge more. All right. We also look at credit ratings, which look similar, and then we'll later look at operating income as well. And again, it looks similar. So it's the better capitalized firms that hedge more. This is all cross-sectional evidence, but of course, we can do it in a regression analysis. But of course, what was exciting about this data is the panel dimension. So you can do this with airline and year fixed effects. And so now, essentially exploiting within airline variation. And what you find, essentially, is we have our various measures of net worth. And there's a strong, again, positive relation between net worth and hedging, even within airlines. Okay? And for example, if you pick this one, what this says is that if you one standard deviation change in the net worth to asset ratio, it changes the risk management by half a standard deviation. So this is also economically significant. You can see here credit ratings work nicely. When you're so triple B minus and above is excluded. When you look at when you're in the double B category, you hedge 22 percentage points less. When you are in the single B category, you reduce hedging by another 14 percentage points. And when you're in the triple C plus category, you actually reduce it by by a total of 55%, so an extra 20%. So monotone and a dramatic relation between credit rating and how much you hedge. And again, better rated, more hedging. We do it also in first differences. It gets a little more iffy. What is significant is still has the predicted positive sign. But there's two estimates, estimates that are insignificant and actually have not the sign that our theory predicts. You might then, so in the model, net worth is predetermined. So the right way to run the regression is to think about risk management being determined by net worth. But you might still be concerned about the endogeneity of net worth. So one way we try to address this is by using operating income essentially as an instrument for net worth. So we first project net worth on operating income, and then use that, so use our instrumented net worth in the second stage. And again, what you find is strongly in the cross-section and with airline fixed effects, and positively, but a little less significantly so in first differences, that there's a positive relation between hedging and net worth. Now, another thing we can do is we can look at, but our theory sort of says that when you get very constrained, maybe all you really are going to do is use all your funds to not be forced to scale down too much. So what we do is we look at distressed airlines, and we have, courtesy of the US airline industry, we have about 10 distressed airlines in our sample. And so what we do is we just look essentially an event study. How does risk management of airlines vary around airline distress? The way we define distress, by the way, the airline is downgraded to triple C plus or worse, or if it's not rated, it declares bankruptcy. And so the pattern is like this. So at time 0, you hit distress. What happens? 2 years before, you hedge almost 30%. A year before, you hedge about 26%. When you hit distress, you hedge less than 5%. Okay, so essentially you almost cut risk management completely, and then it recovers, but slowly. Okay, so essentially, if you want to take only one thing away from the empirical part, I think this is the picture, right? Which essentially says that as you're getting more constrained, you're just reducing, and eventually, if you're very constrained, you're going to cut it completely. I'm sorry? Oh yes. So I must stress one thing. At times there's oh. All right. There's a lot of restrictions on me. No. So this is very important. Investment does not mean that you're investing a lot. What it means is you use all your net worth not to scale down more. So what happens essentially is when you're doing badly and you're hitting this stress, what happens? Well, your net worth actually goes down, and you're now forced to sell off some aircraft and routes. by the time, so at some point you come to the point where you say, like, I could sell off one more aircraft, but it is actually now using my marginal RAV, which is actually quite productive. It's to have enough net worth to do risk management. You say, forget about it. No risk management, I'm keeping this one aircraft. So absolutely. So I'm sure it would also look like people would be disinvesting then. That is not the violation of our theory. That's why, in fact, the firms in our model do that as well. Okay, so then you can say, so what's going on? Well, you might, one advantage of our data is that it's 10Ks, so we can read the 10Ks and see what they tell us. So you cut investment, why did you do it? This is the fraction of airlines that mention collateral or the availability of financing as an impediment to hedging around the same event. So 2 years before, no one talks about this. A year before, 30% talk about it. Upon distress, 70% talk about financing and collateral being a concern and restricting their risk management, and then it recovers again slowly. So, for example, the kind of statements people make is, in order to execute additional hedging transactions, we anticipate that we will, so this is like America West, they get downgraded to CCC, and they cut the hedging to 3%. What do they say? They say, in order to execute additional hedging transactions, we anticipate that we would have to provide cash collateral or other credit support, which we may not be able to provide in a cost-effective manner. There's also some articles in practitioner journals, and they argue that authors have had knowledge of several airline bankruptcies, and in every case, financial officers recognized the advantage of a hedge and understood that they were not in a position to take the appropriate transactions in the marketplace. And in fact, then it goes on to say, well, of course, there's one way to not use collateral is just by options. And then in the one case where an airline considered that, they could not make their business plan work if they would use all these funds to buy all the options. Okay? So, and that's exactly what happens in our model, if you want. Robustness, you might think it's something about financial distress, so we throw out all the observations of firms in financial distress and rerun the regressions. And again, there's even away from distress, there's a strong positive relation between hedging and net worth. Then we do a battery of robustness checks. You might think maybe it's bankruptcy, not distress. We look at that. It actually happens. People cut in risk management when they hit distress and much before bankruptcy. You might be concerned about reverse causality. People hedged a lot. Fuel prices went up. They have a lot of net worth, and maybe it goes the other way then. So we look at it in times when fuel prices go up and when fuel prices go down, and we get the same results. You might think something's funny about Southwest. We throw it out. Nothing happens. There's some airlines that have fuel pass-through agreements. If I would have more time, I would tell you exactly what those are. Essentially, we throw those out and nothing. Again, we get similar results. Airlines lease a lot, and I've been arguing that people should pay more attention to leased capital. But here we didn't want to muddy the water, so we didn't do it here. But we did in a robustness table actually adjust all the capital measures for lease capital, and we actually find stronger results. So I'll continue to preach that, but it's like in this appendix table. And then we'll do everything in OLS also, and that works. What I showed you were weighted least squares regressions. Okay, so 1 minute to go. Some alternatives. One that we can immediately dispose of. So when people just had a cross section, they thought maybe it's fixed costs. Well, here we have hedging at the intensive margin over time within the same airline, so it can't possibly be fixed costs. Right? So people reduce how much they hedge at the intensive margin, so that can't be fixed cost. Risk shifting is maybe the most important alternative. So let me see what I have to bring to the table on this. So we're going to argue that the risk shifting is actually also that our theory is more consistent with the data than risk shifting. First, well, so of course, what is risk shifting? Risk shifting is the idea somehow that bondholders, so a bondholder-shareholder conflict reduces in this limited risk management. Well, first, airlines certainly tell you that collateral is the concern in their 10Ks. Moreover, actually 65% of our airlines actually tell you explicitly that they don't use derivatives for trading or speculation. Now, of course, you say, like, well, what are they going to say? But more importantly, typically models of risk shifting typically predict discontinuous hedging policies, which we don't see. And in fact, we see this strong positive relation even away from distress. So, but maybe like the smoking gun, if you want, is that when airlines are in bankruptcy, actually bondholders restrict how much risk management airlines can do. So they put a cap on it. If risk shifting were the concern, you would expect them to require risk management. So essentially, I'm out of time. So essentially, what we've argued is that dynamic theory actually predicts that more constrained firms hedge less. And then we visited the evidence from that vantage point, and we think that the evidence sort of speaks pretty clearly that there's certainly a very strong and robust correlation, both in the cross-section and over time within firms, that more better capitalized firms hedge more. And that's consistent, I guess, with our theory. Thank you.